Welcome to This Explainer. Today, we're putting on our investment analyst hats and performing a complete, deep dive financial health check on the midstream energy giant MPLX. We're going to dissect their Q1 2026 performance, evaluate their competitive economic moat, and uncover a massive potential shift in their corporate DNA that could actually trigger a major re-rating of this stock's valuation. Let's dive right in.
Here is our roadmap for today's analysis. We'll be covering 1. Q1 2026 financial vitals, 2. Operations and growth strategy, 3. The Marathon Petroleum anchor, 4. Credit health and leverage, and finally, 5. The corporate structure pivot. Section 1. Q1 2026 financial vitals. Let's look at the headline numbers. MPLX pulled in a staggering $3.04 billion in total revenue and other income for the first quarter. Now, yes, that is a slight 2.8% dip year over year, but as seasoned analysts, we know top-line fluctuations are just par for the course in the energy sector. What really matters here is the immense baseline cash-generating power this represents. Net income clocked in at $922 million, which comes out to about 90 cents per diluted share. This looks like a drop from last year, but honestly, it's mostly just accounting noise. We're talking about impacts from routine hedging derivatives, interest expenses, and a really tough comparison against a non-recurring financial benefit they enjoyed back in Q1 2025. So let's look at where the true intrinsic value actually shines. Adjusted EBITDA. That came in at roughly $1.7 billion. Why does this matter so much? Well, if we look at this through a Warren Buffett lens, net income can easily be clouded by paper losses. But adjusted EBITDA acts as a fantastic proxy for true owner earnings. It proves their core operations are relentlessly steady, coming in essentially flat year over year. For you unit holders out there, this all translates to a very attractive 7.31% yield, paying out $1.07.65 per common unit. But here is your Benjamin Graham-style margin of safety, a 1.3 times distribution coverage ratio. Basically, they are generating significantly more cash than they're actually paying out, which deeply insulates that yield. Moving on to Section 2, Operations and Growth Strategy. Let's look at the muscles of MPLX. This business essentially operates on a brilliant dual-engine model. Check this out. Steady growth in the crude logistics segment, which was up $14 million thanks to higher tariff rates, perfectly offset a $42 million dip in natural gas and NGL services. It's a built-in hedge. When one engine faces headwinds, the other just picks up the slack, keeping overall cash flows incredibly stable. And they aren't just sitting still. They are aggressively flexing their growth muscles to expand future cash flows. MPLX is directing 90% of a massive $2.4 billion capital plan straight into the highly prolific Permian and Marcellus basins. That includes the Harmon Creek 3 and Titan Complex expansions launching later in 2026. This heavy, targeted reinvestment is the exact catalyst management is relying on to drive a targeted 12.5% annual distribution growth for the next 2 years. All right, Section 3, the Marathon Petroleum anchor, stability and scale. Marathon Petroleum Corporation, or MPC, isn't just some friendly affiliate. They own the general partner and a whopping 64% of MPLX's common units, leaving 36% for the public. As the largest independent refiner in the U.S., MPC's own success is completely, structurally bound to MPLX's infrastructure. This relationship creates what Warren Buffett would call a massive, undeniable economic moat. And it all comes down to MVCs, minimum volume commitments. You see, MVC accounts for half of MPLX's total revenue, and roughly 60% of MPLX's pipeline and terminal throughput is totally shielded from commodity price swings by these guaranteed fee-based contracts. So whether oil prices spike or crash, it doesn't matter. MPLX still gets paid.
Let's check out Section 4, Credit health and leverage, the structural skeleton.
This financial skeleton easily passes a strict Graham defensive investor checklist. Fitch Ratings recently affirmed their solid BBB rating with a stable outlook, specifically citing those highly predictable inflation-protected MVC cash flows we just talked about. And on the liquidity front, they are pretty much bulletproof. They've got a brand new $2.5 billion credit facility extending all the way out to 2031, plus they're backed by a completely undrawn $1.5 billion loan facility directly from MPC. Looking closely at their debt burden, MPLX was operating at 3.7 times leverage at the end of Q1. That sits very comfortably below management's absolute ceiling of 4.0 times, and it is miles away from the 4.5 times trigger that would actually cause a Fitch downgrade. This strict leverage discipline protects the balance sheet while still giving them the flexibility to fund all that aggressive growth.
Finally, Section 5, the corporate structure pivot, a potential DNA mutation.
This is the big one. Management is actively evaluating converting from a master limited partnership into a traditional C corporation. For everyday investors, this means trading those notoriously complex K-1 tax forms for standard 1099 corporate dividends. But why go through the hassle? Well, institutional investors and big index funds are often legally prohibited from buying MLPs. A C-Corp pivot unlocks a massive new pool of capital, which can structurally lower their cost of capital and drive a significant re-rating of the stock's overall valuation multiple. However, it's a really delicate capital allocation puzzle. Management has to carefully weigh the heavy legal costs and the unit holder tax implications of a conversion against their existing commitments. They need to execute this pivot without disrupting that $2.4 billion growth plan we discussed, or the $1.1 billion still loaded in their unit repurchase cannon. So, as MPLX stands at this major structural crossroads, the ultimate question remains: will they trade their partnership roots for institutional corporate growth? And if they do make that leap, how will that re-rate the valuation for income investors holding the stock today? It is absolutely a fascinating catalyst to watch. Thanks for joining me on this explainer, and keep your analyst eyes on how management navigates this pivot.